And we're live.
That's awesome. Looks like it's working.
Yeah, that's a good feeling.
Yeah.
Thank you, Dan. Oh boy.
How are we looking tonight, everybody?
Good. It's streaming.
Yeah. We got the live
Excellent.
stream
We're
going.
up and
Yeah.
live.
Mm-hmm.
I heard we figured out, Dan, maybe a email interchange.
Kind of Google maybe.
Yeah, there
Mm-hmm.
were some updates within Google that messed up the live stream last time.
Well, I'm always glad when we could figure it out.
Yeah, it was a big head scratcher.
Yeah.
But the good thing is we do have a backup now in case this happens again. So
Oh yeah,
Great.
now we're over prepared. It's great.
yeah. It's
We
always
got a
better to
guide.
be
We
prepared.
have a
Yeah.
yeah, different disaster scenarios and what to do.
I was thinking, just when we think all the pandemic preparations fade away, don't, I guess we never get too comfortable.
No.
Yeah, exactly.
Matt, long time no see.
Great to see you again.
You too, you too. How you doing, Lori?
I'm good. How are you?
Good, good. Um, I know we're gonna miss you on Monday night. Congratulations, I think are in order. But you will be missed. You will be missed, but we certainly understand.
Okay, good. I'm only taking 2 days off, so
If Bay State can even afford that, I
Right.
hope it sounds like you've maybe got some help on the way, which is great to hear.
Yes, absolutely. But nice to see everybody. Do we have the streaming working this time? Awesome. Okay.
We're up and
Yes.
live right now.
Awesome. Thank you, Dan.
Mm-hmm.
So call the meeting to order?
Yes. Lori Martin.
I'm here.
Okay. So Matt can start
Sharing.
sharing one.
Okay.
Mhm.
Perfect. Well, great to see everyone. Thanks for having us tonight to present the results. Even though they are June 30th results, I plan on going through the whole second quarter report, but also just sharing updated results throughout the report, since we are closer to the end of the third quarter. So just by way of agenda here, we'll touch on the governance calendar as we do each quarter, hit on some capital market topics, then dive right into the performance report. Any questions though before we get started?
Nope. Are you sharing that or?
Nope, not yet.
Okay.
And then one other thing, did want to ask if there was any questions about the firm announcement that we had. Lori, I know I spoke to John directly. I didn't know if you had any questions as well.
I don't, but maybe you can just give a quick overview
Yeah.
of what those changes are.
Perfect. Yep. So just as a broad overview, many of you might know or might not be aware, we had Fiducian Advisors had a joint venture partner, NFP. This had been a good, long-standing relationship, dating back almost 15 to 20 years on the DeMeo Schneider side of the relationship. About 15 months ago, NFP was actually acquired by Aon. And if you know the name Aon, you might think of it more through an insurance lens. They're one of the world's largest insurance providers, and NFP has a very large and robust middle market insurance platform, in addition to having a wealth and advisory platform, which we fell under. So they really acquired the entire NFP umbrella. Right from the start, it was apparent that they really wanted those insurance assets and not so much the wealth and advisory assets. So kudos to Aon for letting us and other investment advisory platforms underneath that umbrella explore and exit. So it was announced just a little over 2 weeks ago that Fiducian Advisors, along with 4 other sister firms, will be spinning out of the NFP Aon umbrella to start a new firm. Just in about 2 months from now will be the actual closing date, with the partner capital, so the private capital, being backed by Madison Dearborn, a long-standing private equity firm based out of Chicago, actually at the corner of Madison and Dearborn. That's how they got their name. Who actually has had a long-standing relationship with NFP, so they actually know us quite well. So we're very excited about that, really getting back to just the investment consulting roots. Really, there's no other auxiliary business lines, anything like that. So very excited, and it brings direct scale to our business line. Right before the transition or the transaction, excuse me, we're at $350 billion. After it will be north of 600 billion. So really bring the scale to the marketplace, which will have a direct impact for all of our clients in a positive light when it comes to negotiating fees, vehicles, things of that nature. So very excited across the board. And the most important thing for Stick and all of our clients, there are no changes to the service team, to the philosophy, to the service model, or to fees. So we're very happy with that solution as well.
Okay, great. Congratulations.
Lori, I went to the conference this week in Boston that Fiducian held, and that, Matt, right, was the magic phrase for us, right? Those changes locally for us, we're gonna would not there would be no changes locally. That we keep Matt Frattini. I was chatting with Mike Chase, who we've had through lots of these different iterations, so that was very helpful. And I would even say, Lori, it was fascinating that even there with that context, Matt, and I would say to my team, there was no escaping a conversation about AI. So it's just fascinating the ground that's being covered on that topic, no matter the segment or sector. And so the continuity, Matt, that we're going to continue to enjoy at the college is very, very helpful. Thanks.
Yeah.
Perfect. So with that, I will just share my screen right now. Make this just full screen so everyone can see it. Perfect. Diving right into our governance calendar topic on page 5, upper right-hand quadrant, the second quarter focus is actually our portfolio structure focus. This is where we're looking at the expenses related with the portfolios from a investment management, custody, and also our fees, so the consulting fee. Next, we're looking at the liquidity profiles, and then lastly, attribution. So what has helped from a performance standpoint and what has hurt? So jumping right in on slide 6, you'll see we do a nice job of breaking up the fees into the three main components, starting off right in the top of the page here, the first third, the investment portfolio weighted average fees. You can see that first line item for the long-term portfolio at 0.41% or 41 basis points. We think that's very competitive overall, given the complexion of managers in your portfolio. And what I mean by that is the mix of both active management and passive management utilized in your portfolio. And in addition, the asset allocation structure. So, given that, we think it's a very competitive fee. And I just wanted to add that given the migration of your marketable alternatives mandate from Ironwood to Hyde Park, which is a fund of funds that is going to be managed by Fiducian. That transition will occur during the fourth quarter, where we do not take a management fee for that segment of the portfolio. That 41 basis points is actually going to come down even further. So next year, when we look at this exercise, we anticipate that 41 basis points to come down just a click lower. Next, you can see the short-term portfolio coming in at 0.19% or 19 basis points. This is right in line where we would anticipate that being, given the complexion of fixed income assets for that portfolio. Next, you can see the custodian fee. As you know, the assets are custodied at principal, and you can see principal charges 4 basis points or 0.04% on all assets in both portfolios. In addition, there's a $750 account fee for both portfolios. By and large, that is very standard in the marketplace. We could do an RFP to try and go lower, but more or less you are going to get the same results across the board, maybe a basis point here or there in the positive, but very competitive fees overall. Lastly, you can see our fee, the last line item here. It's a flat fee subject to an escalator. And last year, our fee for both portfolios on an aggregate basis came in at $54,000, and that translates to 8 basis points. So when we look at this all together, we think it's in a very attractive profile, very cost efficient overall. Any questions at the fee level before we move forward?
My only question, Matt, is do you benchmark against an industry standard for assets under management of our size?
You know what? That's a great question. I actually had a client meeting this morning where they were asking that exact same question, and it is very difficult for benchmarking of certain sized portfolios. As an example, if you look at the Cambridge or the Greenwich study as an example, that starts at portfolios of 500 million, and it only goes up from there. But what we can tell you anecdotally from our entire book of business, we think this is very competitive. And also, we are constantly in the market looking for opportunities, answering RFPs, etc. And we think we have a very cost-effective solution.
Thanks.
Just on page 7 is a detailed overview of that 41 basis points I mentioned for the long-term portfolio and its fee makeup. And just one thing I always like to point out is, we benchmark fees against different asset classes here, and you can see how it breaks down in each individual mandate. And just looking at large cap US equities coming in at 2 basis points. Now, the US market is very efficient in large cap, so that's why we are big proponents for indexing. And you can see we're owning the entire area of the market for 2 basis points. But when we compare that to small cap, we want to pay up in that area for active management. And you can see paying 80 and 90 basis points for those areas for active management. Goes over the long term. We think those managers are going to be able to beat their individual benchmarks and bring alpha to the overall portfolio. And then just very quickly from a liquidity standpoint in the long-term portfolio, you can see on page 8, predominantly very, very liquid portfolio, 94% of the portfolio daily liquid and 6% semi-liquid. That 6% is represented by the marketable alternatives or hedge fund section of the portfolio. And then just very quickly, you'll notice on slide 10, this is the exact same slide that we just looked at from a fee standpoint, but this is for the short-term account. 19 basis points all in for a management fee. very competitive overall, given the asset size here of just north of $20 million. And you can see the individual fees on the right-hand side of the page. Any questions on the governance calendar? We'll touch on attribution in a moment. I'm just going to stop sharing my screen and just high level touch on the capital markets. Then we can touch on a couple of charts in a moment. But what has really gone on in the capital markets in the second quarter and pretty much continued on in the third quarter has been a lot of volatility. And if we think back to where we were in early April, it was quite interesting. It was really about tariffs and trade policy. If we think back to April 2nd, Liberation Day, the president announcing that we were going to have sweeping tariffs across the board. There was a big presentation in the Rose Garden, and the markets responded quite drastically to that. And the markets really just fell off a cliff in the US. If we think back to where we were mid-April, US small caps were down almost 20%, large caps were down close to 15%. About 2 weeks after that announcement, the president came out and announced a 90-day pause, and the markets rallied very dramatically, and they've been rallying ever since. And you're going to see that in the results tonight, and then also in the quarter-to-date results that I'll be sharing with you. And it's interesting that they continued to rally because the quarter was bookended. We had tariffs and trade policy at the very beginning, and at the very end of the second quarter, we had the big, beautiful bill that was signed by the president as well on the fiscal side. It'll be interesting to see how that impacts the overall economy in the years to come. It is going to add, though, a considerable amount of debt when you compare that to GDP going forward. So that's just another thing that we're keeping our eye on internally and how that is going to impact the portfolios and also the overall capital markets. And you know what? Just tying this all in at the same time, you have the Fed in the background trying to navigate the markets. We have a dual mandate with the Fed, stable prices and full employment. From stable prices, this is where we're looking at CPI or PCE. And overall, we've been making slight marginal gains, beating expectations, but the overall number is going in the wrong direction. So just as an example, August prints came out at 2.9% for CPI. We want to be at 2%. So we have been slowly working our way up the stairs instead of down the stairs. So that is definitely moving against the overall Fed's mandate. But one thing that the Fed was not counting on is having a weakened labor market. And that's something that we really saw come out both in June and July. We saw massive revisions downward in the labor prints, something that no one saw coming, which is very interesting. And then we just about 2 or 3 weeks ago, we had the benchmarking study over the last year, which saw one of the largest revisions we've ever seen in history over the last year, bringing down the overall jobs print by about 1 million jobs over the last year. So that was very surprising overall, which really led the Fed yesterday to cutting rates by 25 basis points. So if it was up to the Fed, we wouldn't have seen a cut based off of CPI prints, anything like that. But they, I think, are being very proactive now based on the labor side of the equation. And I think that's a nice segue right into our next chart here. On slide 13, on the left-hand side, as you know, this was through June 30th. But what we're just looking at here is the Fed and the US is the top line here. As you can see, it looks like a mountain overall with the Fed hiking and then slowly cutting rates here. If we updated this through yesterday, this number would say 4.25% rather than 4.5%. But as you can see, we're leading the way overall, and this is not a number that personally we would want to see high in this situation. It's been a little bit restrictive overall in the economy, especially when you compare it to other developed areas around the world. Just one particular, the Euro area, the Eurozone. They have been consistently cutting rates all the way back to last summer. They're down at 2.15%. And this actually ties in nicely to one of our themes here, and this is the weakening dollar. So we have seen the dollar weaken considerably since the start of the calendar year. What has been contributing to that? One is the central bank policy that you see on the left-hand side of the page. Just wanted to point that out, but I think it really helps by looking at this chart on the upper right-hand side of the page. It shows the relative strength of the dollar versus other currencies around the world. And you can definitely see, looking at the far right-hand side of this chart, the dollar has weakened. There's no doubt about it. It's fallen off a little cliff here. But if we put some context around the actual data point, I think it tells a very different story than if we just looked on a year-to-date basis. So what we did was we put it on a overall 20-year average, and that's that dotted blue line here. And as you can see, we're still well above our 20-year average for dollar strength. And you can see we are actually well above where we were pre-COVID and actually after COVID as well. So if you just put more context around this, it does show that the dollar is strong overall in longer terms. But one of the positives for a weakening dollar in your portfolio is you are invested in international equities. And when we have a weakening dollar, that is a positive as we're repatriating those dollars back to the US. Any questions on our key themes before we touch on the capital markets quickly? Perfect. Just looking at page 14, left-hand side of the page, and as a reminder, these results are through June 30th. The bars are the year-to-date returns, so the first and second quarter, and the circles are the second quarter results. You can see the third bar in from the left, core bond market up 4% and had a nice overall quarter up 1.2%. But the real story is in the center of the page, looking at the gray bars. US large cap for the second quarter really led the way overall. Quite the reversal from what we saw in the first quarter, as we saw once again AI and technology names leading the way, bringing the overall index up 11.1%, and on a year-to-date basis now up 6.1%. And then just if we look at small cap, up 8.5%, really helping that overall return from where we were in April. If you remember back to April, we were down close to 20% on a year-to-date basis. So finishing off the quarter only down 1.8% is a significant improvement overall. But continues to see international equities lead the way. As an example, international developed up 19.4%, really led by, once again, the weakening dollar and the Eurozone continuously cutting rates and having very accommodative monetary policy. In emerging markets, up 15.3%. The only real negative on the page from a quarter is commodities. You can see down 3.1%. This is driven largely by the oil market. We had a massive imbalance between demand and supply. We saw the OPEC region really flood the market from a supply standpoint, and demand was not there to meet it. So overall, oil prices did lower overall commodities market. Just very quickly, bringing you up to speed on a quarter-to-date basis. So looking at these numbers, how do they fare so far? Now, on a year-to-date basis, the aggregate bond index is up 6.5%. Very strong returns overall. Looking at US large cap, we are now up 13.3%. The very rate-sensitive small cap area of the market on a year-to-date basis is now up 9%. So completely erasing this negative 1.8%, and now we're up 9% year-to-date. And then both of the international segments, international developed up 25%, and then emerging markets up 27.6%. Continue to see very strong performance overall. Any questions on the capital markets? Perfect.
More just a comment for Lori. Lori, if I said the name Carol Duramia from MFS, you've probably heard of her.
I don't know. Didn't ring a bell.
Matt, tell me the title she has at MFS now.
So, yep, Carol is the president of MFS and also the head of global distribution.
So she comes to mind, Lori, because she spoke at the Fiducian conference and she really advocated for long term. And I guess Matt, MFS is sort of known for long term. And again, it's a reminder to me, especially with 67 million under investment as opposed to 15 million not that long ago in our own history, about how much, Lori, that our view quite literally can now be long term and steady. And I think it helps with a lot of the volatility And I think, Matt, as people in your industry would say, when you're looking for value, how if you're not necessarily chasing short-term returns, again, not to belabor it, but there was a fascinating chart where she showed, and again, I wouldn't know her data source, Matt. You'd probably have to help me with this, that the average stock, let's say in the 80s, was held for 8 years, and it's held now for 5.5 months.
Yeah.
Spot on.
It's right. So just Matt, do you want you to see? I'm trying to pay attention, and Lori, for us, there's just lessons to really be learned with this great information.
And another key takeaway as well was just the full market cycle dynamic. If you ask a committee member what a full market cycle is, they might say, 5 to 7 years. But then if you look at the market over the last, 50 years, it's actually closer to 10 years. But you see a lot of different committees, boards, etc., evaluating their portfolios on a 1 and 3 year number. But everyone acknowledges up front that a full market cycle really should be the evaluation key, but they're not standing by that. So just moving forward, there's one thing I did want to highlight on slide 22. So during the second quarter, we did complete the $9 million dollar cost average program from the short-term portfolio to the long-term portfolio. And subsequently, we started the second dollar cost average program of the $5 million tranche. That first tranche was actually completed in August, so taking $2.5 million from short term, investing it into long term. And you'll see the next tranche is actually scheduled for November. But one question for Lori here, just from if you have any objections to this or not. As you know, we have the hedge fund transition occurring during the quarter. We would love to use a part of those proceeds and move that up to November 1st just to bring the overall target to hedge funds in line rather than doing it December 1st. So we would take roughly 60% of that $2.5 million and invest it 2 weeks earlier rather than mid-November. Of course, we would then take this remaining 40% and do it on that normal cadence in the mid-month if that's fine with the group.
From my perspective, it makes sense to take advantage of the liquidity at that time.
Perfect.
And this is where I always appreciate the flexibility, Lori, of our policy, right? That it's well within that, Matt. So
Perfect. Just didn't want to, go out of bounds here and take any liberties. Then just jumping right ahead, just in the interest of time, to slide 26, you can see portfolio performance right on the top third of the page here. For the quarter, the portfolio is up 6.2%, and then also on a year-to-date basis, up 6.9%. You notice that both on the year-to-date basis and the 1 year, we have trailed as well as a 3 year basis, but very strong absolute numbers. If you look at the 1 year number, up 11.2%, trailing the benchmark by 1%. Similar story though on the 3 year number, up 10.4%, annualizing over the last 3 years, but trailing by about 1 percentage point. And that has been driven solely by some short-term manager underperformance, but really that has been driven by our overweight to small caps. That has been a big headwind in our portfolio overall over the last 16 to 18 months. But we've seen a major rebound overall. Once the Fed just started about potentially cutting rates, we've seen the small cap market take off. I gave you the results on a year-to-date basis, but just in the last 7 weeks, small caps are up 11% and large caps up 7%. So we really think that once we continuously see rates coming down, the Fed signaled that we might see 2 more cuts this year. We think that'll be a nice catalyst overall, and we might see some nice performance from small caps, which would be a nice benefactor to this portfolio. But absolute results are still very strong.
Did you see it in July and August?
We've definitely seen it in August when we look at results, especially comparing that to large cap.
Okay.
And then just very quickly, just from a dollar standpoint, you can see the portfolio finished off the second quarter at $45,700,000 approximately. You can see the contribution that we just discussed coming into the portfolio at $3 million. There was also an investment gain of $2.6 million as well. We ran the portfolio's updated balances through last night's close. The portfolio stands now at $50,150,000. That does account for another $2.5 million inflow, but very strong results overall. And on a quarter to date basis now, so that counts July, August, and first couple weeks in September, portfolio is up another 4%. So on a year to date basis, up 11% overall. So very strong performance, really utilizing capital markets quite nicely. And then I mentioned we would touch on overall attribution very quickly. Just on slide 29, you can see on the 5-year basis, the portfolio is up 8.9%. The benchmark is up 8.4%, leaving overall value added at 0.5%. So where does that 0.5% being derived from? That 0.5% is being derived solely from manager value add. And you can see that breakdown lower right-hand side of the page, really coming from the fixed income segment, 40 basis points or 0.4% of that overall coming from the fixed income managers. Andrew, do you have a question? Oh, I can't.
Yeah. All right. I don't know why. Never mind.
We couldn't hear you, Andrea, but you could type it if you wanted to.
Okay. Just on slide 30, just looking at the composite level for fixed income, as I just mentioned, very strong performance from the fixed income managers across all reported timeframes. Looking at the 1-year number up 6.5%, benchmark at 6.1%. No issues or concerns with any of the managers in the fixed income allocation. We have seen a nice really nice performance across the board, but the diversifying segments have really shown quite well. Just looking at BlackRock, up 8.4 versus benchmark at 6.1 over the last year. Unconstrained mandate, shorter duration profile, able to invest across the board, has really been able to take advantage of this environment that we're in now. Looking at domestic equity, as I mentioned, this was the area of the portfolio that has been struggling recently. On a 1-year basis, up 13.3% versus the benchmark at 15.3%, really due to both of your small cap managers. As we know, both large cap and mid cap is indexed because of the market efficiency. So just highlighting very quickly both of these managers, Hotchkiss and Wiley, on the quarter up 2.7% versus benchmark at 5. But over the last year, you can see up 1% when the benchmark's up 5.5. Now, what's happening here? It really has to do with Hotchkiss and Wiley's, smaller company bias within small cap. They tend to invest down the spectrum, small cap. That's been a major headwind for their style of investing, as we've seen rates being higher for longer. As we know, smaller companies are more reliant on borrowing costs, etc. So we think this would be a nice benefactor for lowering interest rates as well. They were also underweight technology and overweight energy. As I mentioned during the quarter, energy was one of the only areas that sold off. So that was a headwind to their style as well. But longer term results still very well intact, looking at the 3 and 5-year numbers. Similar story with Conestoga small cap growth, except this is a quality story. Conestoga is extremely high quality, very particular with the companies they invest in. And what we've seen in small cap growth is a low quality momentum led rally. And what I mean by that is we're seeing companies with very little earnings or no earnings lead the way. So when it comes down to their underperformance, it's due to stock selection because they're not owning the names that are outperforming and leading the market overall. So this is within healthcare, technology, and industrials. And you can really see that play out in their 1-year number. They were up 2.9%. Benchmark is up 9.7%. And then lastly, just on slide 32.
Can I ask you a question, Matt?
Yes.
Cap? So because the dollar amounts are so small, have you considered or modeled looking at like the Fidelity, SMID, or is there overlap? Does it make sense to have, those allocations at this point with the fees and the performance?
That's a great question. Even with smaller dollar values, we think it's impactful because on a percentage basis, it's there. So if it was, 50 basis points, we would not advocate for that position. A 1% point, holding, we would not advocate. But at 2 percentage points, we do think that's meaningful. Because if you put those both together, we're at 4%. We do think that's a meaningful position overall, and especially across the full market cycle.
So no overlap with the Fidelity mid cap index at all.
Overlapping with mid cap, a lot of the names that they would own if they started running, there's a possibility. But Hotchkiss and Wiley has really down cap, and then Conestoga is very concentrated, so they are owning, 50 names. So there is possibility there's overlap, but it is not to a great degree.
I just I'm trying to wade into the waters here, Lori, a little bit. So forgive me. To the point around long term. And what I hear, of course, is with small cap, right? The idea of it's a very different view on earnings versus value, right? And maintaining a little bit of that positionality. Are you convinced, Lori, about the long-term approach when you see 5 and 10 years on small cap does help? But it's more the what's your patience level, right? For
Right.
something like this that is as modest as this, if I can ask it that way.
Right. And I think I would want to kind of do a, look back 10 years and kind of look how would it have been if we just did the SMID, which is small mid cap, more index than the active funds, because you would have saved on fees, and you would have had less volatility. I mean, we're just doing that in our portfolio now. So it's just something to think about with those percentage of allocations. It's small dollars there. That's just a thought.
Yeah, we can certainly follow up with that as well. And then just on slide 32, looking at the composite line at the very top of the page, international equities done quite well, up 16% over the last 12 months, and on a 3-year annualized basis, up 13.2%. Really, only one manager jumps off the page here, and it is quite for the wrong reasons. That's GQG, has a very tough 1-year number here, down 3.9%. When the actual benchmark they're compared against is actually up 17.7%. So just putting context around this is very important. GQG was one of the best performing managers in emerging markets over the last, call it 3 years. So 23 and 24, they were top percentile performers. And then the last 12 months, they've really hit the wall and fell off the cliff. And what is the reasoning for that? Underweight China. They have virtually no exposure in China. China's had a very large comeback. They are very underweight South Korea. South Korea, as you know, was one of the top performing emerging markets country. And they're overweight India. They're almost twice the benchmark weighting. They were twice the benchmark weighting exactly at the beginning of this year. They've tempered that back a little bit, but still considerably overweight. And India has really struggled so far in the first 2 quarters of the calendar year. That's been a big headwind overall. Underweight technology, and they've also had issues in stock selections in both financials and energy. Now, we completely own this. We know this very well. We're in constant communication with the manager. We're almost having, I want to say, bi-weekly calls with them to really get a pulse on this. They are highly convicted in their strategy, their underlying holdings, etc. We still stand by this. Their longer term results are still very well intact. If you look at the 3-year number as an example, even with this very tough last year, they are still ahead of benchmark and considerably ahead of benchmark on a 5-year basis. Just wanted to bring this to everyone's attention, though, that we do have a pulse on this and are monitoring it very closely on your behalf. Any questions?
Does it change? Does your manager status change to monitor at all, or you just leave it the way it is?
Yep, so it's still on maintain. If there was the next level up would be discuss. It has not risen to that level from a performance standpoint, but if they were to make any changes from a philosophy strategy standpoint to try and make up the difference, that's when it would immediately get a status change.
Okay.
And then just very quickly, real assets, we did see principal struggle over the last year, up 9.1%, benchmark up 12.5%, really due to commodities and energy. Overweight position in commodities was a real headwind for their style overall. Any questions on the long-term portfolio before we move ahead to short-term? Perfect. Just very quick.
Just always appreciate the candor, Matt. Thank
Yep.
you. Right. I mean, there's a lot of numbers in there, but appreciate you really helping draw our attention and again being open about it. Again, I struggle, Lori, sometimes with this idea of how long the duration is that you kind of have to endure sometimes, right? And Matt really sticking to the rational outlook on these things. So it is a lesson.
Yeah, it is tough. How long of a leash do you want to give these managers? But you have to be patient in our view. The best managers will end up in the bottom quartile on a 5-year basis or a 3-year basis. So it's really about being patient and not selling at the wrong time. Just on slide 43, though, looking at the short-term portfolio, it continues to perform very well given the underlying goals and objectives. On a year-to-date basis, upper left-hand side of the page, up 2.5% versus the benchmark at 2.3%. Similar story, looking at a 1-year basis, up 5.4%, benchmark at 5%. In dollar terms, portfolio finished off the quarter at $20,590,000. You can see the resulting net inflow from that overall $5 million contribution of $2 million, and we had an investment gain of $236,000. Similarly, this portfolio is in positive territory. Quarter to date is up another 1.1%. So continues to perform quite well. Underneath the hood, all the managers in both portfolios have our firms maintain status, so no issues or concerns from underlying teams, philosophy, strategy standpoint. We're very well convicted in the underlying asset allocation, and we're very happy where the portfolios stand today. Any questions or anything I did not hit on?
No, that was a great overview. I appreciate your insights. Thank you.
Perfect.
Last thing, and I promise I won't talk about this conference anymore, everyone, I swear. But there's just it's an interesting time, Matt, right? I mean, this higher ed is so dynamic, right? Markets are so dynamic, everything. There was a slide, Lori, that the other gentleman, Rob Arnott, Matt showed,
Yes.
and he basically showed what were the top 10. I can't remember I think it was in value, not in earnings, right, Matt? Top 10 companies in value, decade by decade. And it's just a reminder of how much things do change. And his caution, right, is even the tech stocks that are big now, he said, whoever came up with the term the Magnificent Seven never watched the movie,
Right.
because there were bad things that happened before those Magnificent Seven. Like, a great presenter, Matt, right? But it
Yeah.
really caught our attention. Things like that could really, Lori, be helpful for our board of trustees too.
Yeah.
The idea of a
Absolutely.
back-end foundational, just educational view, Matt. So to the extent offline, we could talk a little bit about, are those proprietary? Can we use slides like that? Can we have Lori as the emissary share some of that with our board of trustees? Now that we have these kind of dollars under investment, Lori, I'd just like to really be thinking about how we educate the board broadly around some of these fundamentals. And again, Matt, the takeaway for me really is things really do change. Patience continues to be a virtue, and I think that will help really illustrate it, because our board, Lori, is going to know stocks from the 1980s are nowhere to be found now, right?
Right. Yeah.
So
And
I leave that last thing. Go ahead.
And I think the main thing, exactly what you just hit on, is the case for diversification. Because his main charts were, if you were in the 80s, you were with Japan. If
Yeah.
you were in the 90s, different story, 2000s, you're in the technology names. And if you look at those technology names, both Apple and Microsoft were not even in the top 30. And now you look in the 10s, they were leading the way. So it's really just a constantly evolving marketplace, economy, etc. So it's just the story for diversification across the board, not just by country, but by style and manager.
Yep. Fiducian has great slides. I use them all the time. Okay, I know it's late. Any old business or new business we need to cover? I think just the allocation or the investment of the additional cash, but everybody's okay with that?
Especially if you are. Thank you.
Okay. Okay. Our next meeting is November 6th at 4:30. And so a motion to adjourn. Okay.
Thank you again, Trustee Martin. We appreciate it.
Thank
Have
you.
a great weekend. Cheers. And we'll see you
Thank you.
soon. Yes.
Thank you.